How to Manage Personal Finances book, Chapter 10, Roaring Kitty and How Stocks Are Traded. And as a reminder, I'm posting a text version of the entire book on Substack, which you see here, and a video versions on a playlist on YouTube. You can email me for details on my fifth book, publishing late 24 or early 25. So who is Roaring Kitty? Well, he's having his second 15 minutes of fame. Roaring Kitty is Keith Gill, a popular influencer on Reddit who gained fame by recommending GameStop stock during the meme stock trading frenzy. If you want to know more about it, there's a movie called Dumb Money that is a good but not great movie that dramatizes the meme stock trading in recent years, who won, who lost, regulatory issues, etc. Pretty good movie. As of June 12th, 2024, CNBC reports that Gill owns 5 million shares of GameStop common stock and a huge position in GameStop stock options. Now, I'm not going to talk about stock options in this video. We're just going to talk about the stock. Here's the stock price of GameStop for 5 days in June of 24. You can see, according to CNBC, that it's a roller coaster. The price is up and down, a change of almost 50%. Why is that? You see huge volatility due to people speculating on the price of GameStop. And this is a great way to introduce how stocks trade. And you can start this discussion by asking, if I sell my GameStop shares, is there a willing buyer on the other side of the transaction? And what price are they willing to pay me for my shares? Bid price, ask price, and the spread. So let's say you own a different stock, IBM. It's publicly traded stock, meaning that the stocks are registered with the SEC. The stocks trade on an exchange. Let's assume NASDAQ, one of the exchanges, reports that IBM's trading at around $150 a share. So stocks trade with a bid and ask price. The bid is what you can currently sell the stock for. The ask price is what you would pay if you bought the stock, and the difference between the bid and ask prices is the spread. And the spread can be thought of as the profit earned by anyone making a market in the stock. It's as if you put the stock on your shop's display window at the ask price, say $150. It's as if the market maker is a retailer. If someone brings stock into your shop and wants to sell it, they would receive the bid price. Let's see, that's $149.50. With improvements in technology, the spread on a large stock like IBM is very small. It's an efficient market. Movie line ticket, how the bid price is determined. So what is stock trading? If you want to sell IBM stock, you receive the bid price. We've experienced huge periods of huge price volatility swings in recent years, not only with GameStop, but stocks in general. And what that means to you is that the bid price can decline rapidly in a volatile market. The price that you receive for your shares may be less, maybe much less than what you anticipate. And the analogy here is, think about a movie theater. You notice 5 people in line for tickets as you pull up to the theater. Since the line isn't that long, you decide to park first rather than let your spouse out to grab a place in line. After you park and head to the ticket window, now there's 20 people in line. The same thing can happen when you want to sell your stock. The line can change. With stocks, you have a certain number of people who are willing to buy the stock, possibly your stock, at a given price. So say, for instance, that there are 50,000 shares at the $149.50 bid price. Those 50,000 shares are similar to the people who are waiting in line. You can get the bid price, which could be anything. Assume that bad news comes out on IBM. Well, those buyers at $149.50 may decide against buying at that price. Say, for instance, that 40,000 of those shares, interest in those shares at $149.50 goes away. They only want to pay $145. You have a market maker who's dealing with buyers and sellers, each of whom is buying and selling a different number of shares and has an interest in a different price. Since 40,000 shares worth of buyers at $149.50 went away, there's only 10,000 shares that are actually traded at $149.50. And if you weren't toward the front of the line in order, waiting for your order to be filled, you may have to settle for a lower price. As more buyers cut the price they're willing to pay, the bid price declines. Your stock, sadly, is on sale. It's declining. So let's shift and talk about the GameStop trading risk. GameStop and other meme stocks that you've heard about, AMC being a second example, illustrate the bid and ask system in the extreme. During the last GameStop trading frenzy, people who put in sell orders had sell trades get executed, meaning that the order got filled at prices that were far below the bid price when they placed the order. Why? The stock declined sharply. As buying interest evaporated, the bid price crashed. So what's the lesson here? Less volatile stocks have smaller fluctuations in bid and ask prices. The sale price you receive or the purchase price you pay may not be much different than the current bid and ask prices when you place an order. However, when you buy and sell orders for volatile stocks, the prices can change sharply. That's as far as we'll get right now. Remember that you can find all the content for the book on Substack and video, and you can email me for the book's publishing date. Thanks for watching.